Hello. Hopefully we have everybody here. Good morning, or I should say good afternoon, depending on which time zone that you're calling from. I'm Dominic Gammarati, and I'm the Managing Director for Access here. And I'm joined here today by Ted Bissell, our Global Director for Digital Consulting here at Access Corporate, which covers our data and analytics practice. Thank you for joining us today. We have a diverse audience of participants in different time zones, representing a number of different financial institutions. So glad to have the turnout. I appreciate your time today. So today, what we have prepared is a very informative webinar. It's titled Reaping the Value from Analytics in the Financial Services Business Area. Okay. And just a little bit I'll cover with you in terms of the flow and logistics of the call. We've broken this into really four main sections and a Q&A at the end. We have an introduction and background, and then we'll go into and cover a bit about the origin of analytics and current developments, give you sort of a baseline where we currently stand today. Then we'll move into bringing analytics to financial services business tasks and some of the key business areas that are both driving and requiring this change. And then we'll move into, where do we go from here? How do we pull all this together? And thus titled, reaping the value from the analytics efforts. Okay. So let me just, what I'll do next is if we can go into a little bit of the background and introduction. And so this will set us up and we'll get into some of the different sections and topics that we've outlined for you. Okay. So a little bit of the background. So point one being, data and analytics continues to make leaps in capacity and accuracy and sophistication. So, I mean, essentially, I think we all see this every day in our work and personal interactions. It's here to stay, right? And every day, I think we're all probably pretty amazed by things that data and analytics is creating in terms of its sophistication. So it's here to stay and something that'll probably continue to develop and accelerate at a fairly brisk pace. We also noticed that there are, headline-grabbing startups in financial services, essentially at every level of the industry and all different levels of analytics sophistication. And what you notice that these new players, they're very agile, and and despite their small customer base, they don't have legacy issues, right? So they're very agile, very nimble players, and their ability to compete is based upon their capability of developing insights from these data sets, right? But even though they have brief customer relationships, their agility truly is an enabler for them to gain market share, which they are, right? And we see these challenger and new players essentially popping up every day in different areas of different subsectors of the industry. Next point here. Traditional banks and financial institutions, most of them are not yet structured to handle the drop in analytics, right? Most of them have vast and disparate data sources that are not linked together. Assets such as, once data warehouses, now data lakes. Major investment dollars have been thrown at these initiatives and will continue to be, right? And as a result, the larger banks, of course, hold on to these data sets, right, from long and established customer relationships. But again, these things are often scattered throughout the organization, right? And sometimes they can be helpful, and in many times, they're not being leveraged. In many cases, we see them not being leveraged to their full benefit, right? And then, again, I think the bigger banks too, or what we see with the bigger banks as well, is there's just limited experience in how they reconcile that traditional data and all these various unstructured data types that they have. Okay. And then last point here, introduction, then we'll move into some of our sections. Financial institutions can maximize, however, the return of data and analytics. And if they do that, they can, by deploying the right level of sophistication, and I think it's key for them to really identify what it is that they're going after in terms of their bigger win, right? I mean, our feeling too here at Access, since we deal with so many customers in this challenge and this evolution, is we think we can maximize the value of data analytics for the banks to help them evolve, compete, and thus grow their business. Okay. And then just real quickly before we go into the next subject, and I'm going to introduce Ted, who's going to cover some of these topics. If you have questions as we go through this, if you notice there on your panel, your webinar panel, you can queue up a question anytime. So we budgeted this to cover the full hour. But we budgeted within there for there to be a Q&A session at the end. So we would encourage you to queue up any questions that you have while they're fresh in your mind, and we promise to get to them as we get to the conclusion of the presentation of the content. Okay, great. So as we go into now, as we said, really the first section I want to talk about is the origin of analytics and some of the current developments. And I think perhaps, Ted, a good starting point. Right, so we all can have a kind of a baseline as to where we are today, right? And I think one of the things that we see, and probably perhaps a lot of our participants see, is we hear so much today regarding the importance of data analytics, and it's not a brand new term, right? But we know it's different than it was historically, right? So perhaps you can get us started on, what are some of the areas of data analytics that are transforming the fastest? Right, and what's influencing change in analytics, such as the consumer familiarity or the pull, and what's going on with the bank and client demand. Right, maybe it'd be a good way for us to get started and have a good foundation for the balance of the conversation.
Certainly, thanks, Dominic. And I wanted to also wish everyone happy morning, afternoon, or evening, depending on where you're joining us from. So thanks for your participation. Well, analytics has been around for a long time, in fact. We started off with punch card machines over 100 years ago. Some of you may be old enough to remember thick printouts, our graphical display terminals, which were used for some basic analytics. We had punch cards. We had some analytics playing into the Lunar Commander system for the Apollo missions. So this technology has really been around for a long time. But in fact, nowadays we've come into kind of four basic categories for analytics, which are descriptive, diagnostic, predictive, and prescriptive. And they really have slightly different roles, especially in financial services. So the descriptive, the most basic, is what we see a lot around data mining, around pattern detection, around looking at clustering and cohorting, so kind of looking at common patterns and spotting where there's a mix, and then also a focus on past performance, so taking historical data. So in financial services, we can use that for historical credit risk assessment, looking at tracking fraud events, some basic customer segmentation, and some analysis of sales cycles. Now, moving to the next level, we're getting to diagnostics. So here we're looking a little bit more at discovery, looking at causality and measuring effectiveness. So we can use that for social and advertising campaign metrics. We can look at contact center performance and also the overall effectiveness of CRM platforms. As we move up to the higher levels in predictive, we can draw on past patterns of big data to be able to predict future performance or to predict future decisions or choices. We can use this for some higher level forecasting, optimal customer interactions, and finally automated decisions. So again, we see uses in fraud trends, looking at kind of overall where the fraud vectors are rising. We can use that for product strategy, resourcing, resource allocation within marketing, and finally streamlining how we are onboarding customers. Mm-hmm. And then the highest level, of course, is prescriptive. So here we're going to want to not only answer but also formulate some specific questions and being able to create recommendation engines. So we can use this to suggest the right products and perhaps even to select the right portfolio. Robo Advisory is the buzzword that's often comes up there. So we see kind of a general process for transforming that data into analytics insights, and that starts with some sort of ingest of the data itself. That moves into a data warehouse or a data lake, and then building an analytics process on top of that. So in the case of financial services products, the next step there is to actually structure a product, more often than not done in non-real time. So this is taking advantage of the data, analyzing it at human speed, and deciding what are some of the products, then moving on to actually offering that product into the market, and then evaluating adoption. Again, not in real time. And what we can do is we have a feedback loop, so that feedback can go back into the analytics process to say, how did the analytics serve us in helping define this product? We can also use this in the risk space. We can use analytics to create some risk algorithms, predicting then risk in a particular process and comparing that to actual. So the middle and the back office also can take advantage of these investments. Now the higher levels are actually using analytics in a dynamic way to propose the product itself. So no longer is this a pre-structured product, but it's analytics ready to go to actually create the product based on the environment. We can still measure adoption. We can still use the feedback mechanism for improving the algorithms. But what's also interesting is that at these higher level of data, we can improve the quality of the actual data as it's being compiled in the warehouse. So that's kind of a nice goal and kind of a self-fulfilling advantage of having that technology.
Driving more value out of that historically.
Yeah, very clearly. So let's look at some of the increasing sophistication that we're seeing in analytics. Business intelligence has been around for a long time. That lets us collect and integrate structured corporate data. A lot of big initiatives, big expensive initiatives around doing that. More often than not, this is archive data rather than live data, used for decision support. And the output is typically a visual presentation. So we have beautiful graphics. We might have a dashboard that's used to be monitoring situations, but it's still human interpretation of the data. We can use that for historical data, probably for current operational data, and at a very high level predictive presentation of data. Then we move into distributed computing. This is the Hadoop and other platforms of the world. So this is introducing unstructured data because these platforms are optimized for doing that. It can be highly scalable and can be very efficient for processing large data sets. Here we can start to get into discovery. We can get into aiding decisions and higher levels of visualization. And then the common enablers beyond Hadoop would be the map-reduced algorithms. TensorFlow is getting more into the machine learning. And R is also a visualization tool. You can also, Tableau is a common visualization tool used there as well. Then we get in now, the next levels that we're just getting into now in financial services are narrow or weak artificial intelligence and getting into machine learning. So here we can apply a narrow set of instructions and expect some amount of task-based automation in the mix. So it's a simulation of human intelligence within a limited range, within a structured range. We can detect patterns. We can start to make predictions. But we can also start to recommend. We can start to cluster customer groups, our habits, and make some classification. Important here is the fact that there's some continuous learning involved. So all the knowledge that we're acquiring is feeding back into the mechanism, and we take a lot of advantage of incremental data as it becomes available. But within this mix, there's not a lot of resiliency for failure. So, we still have to kind of keep things relatively bounded. More interesting is when we're starting to use neural networks. So here, we're getting to a wider range of features in here. So classification, perception, understanding data, discovering things, prediction, and also creation of new products. Neural networks are involved. TensorFlow is one example. We're looking at multi-layered neurons and nodes, and getting more dependency on the quality of the data and the quality of a data feed, if we're talking about live data. The space that we really haven't seen a lot of yet in financial services is cognitive computing, and this is really getting close to human cognition, higher level reasoning and understanding, relatively minimized dependency on structured data. So this is the way that we as humans have to work. But I'll point out that really the current areas of momentum in financial services are ranging from the distributed computing into the first areas of neural networks.
Okay, all right, great. That's a good point. I mean, it's a great, I think you've laid it out here in terms of this evolution or maturity model, right? It's helpful for all of us to understand, right, where most financial firms sit today, right? Because that's, I think, right, where we want to understand where we're at, where we need to go. And then perhaps, I mean, maybe just quickly, I know we have some examples that we want to kind of look at quickly too.
Sure.
Maybe just touch on a bit of, what do you see some of the obstacles and challenges that banks face today? I mean, maybe you can spend a little bit on, what's holding them back, right? I mean, so, when you're trying to move along this curve, right? What are some of the things that, that you notice are, biggest hurdles?
Well, certainly a lot of these technologies are relatively new, and their success is based on a knowledge of data science, which is not commonly found in the traditional banking environment. And so you're dealing with something that's relatively fresh, that then therefore not automatically delivers results right away that everyone can see and say, wow, this was great to put this in place. So if you have a big hurdle of putting data and structured data and getting it into a data lake, interestingly, the technology itself, the core technology isn't hugely expensive, a lot of open source data and a lot of scalable platforms, but the process to make sure that this very carefully compiled lockdown data sets that a bank would have can be safely brought into this environment is very expensive and requires a lot of sign-offs and so on. And so that may be holding us back. I mean, if we look at some of the examples here, we're seeing that some of this is starting to come into financial services. So Kazisto is the startup that has a social intelligence powered chatbot. So we're starting to see some artificial intelligence moving into the space. FeedZai is a company that has a fraud detection platform that's looking at a lot of different non-traditional data sets to determine where there might be card fraud and actually how to handle those events. And even Hearsay, which is using some of the principles around social media listening to use machine learning and getting some sentiment analysis out of that. So I think what we're likely to see is some early successes in a particular niche area that builds momentum within the organization for saying, I want to do that too. I want to take advantage of some of the data sets that we're compiling.
Right. Yeah. Now, these are some great examples, and like I said, if you have questions related to some of these, again, feel free to queue those up, and like I said, we'd be happy to touch on some of this more at the end. Let's move into our next section, talking about bringing analytics to financial services and the important business tasks, right? Because that's really what's really going to matter the most. So Ted, perhaps we can discuss just how data analytics is impacting key business functions for the organizations today, and what firms really need to be doing and managing today, right? Versus what historically they've been used to doing. To kind of give us a sort of lead into that, what are some of the hurdles, right? About handling some of this unfamiliar and unstructured data that they're dealing with, and we're also seeing really fast growth in the e-commerce space, and something we experience in our daily and professional lives every day, and a lot of this is linked to digital payments advances and the roles that analytics has there. So perhaps we can explore those points.
Sure. Well, this comes back to the structure that we've already talked about a little bit, which is kind of looking at the level of sophistication we have to start with in analytics, and based on where you're starting, that can tell us a little bit more about what we can possibly do. So, a very basic first step would be to take advantage of analytics to start structuring products, in financial services, typically delivered through traditional human-to-human channels. So this might be providing some basic forms of advice to relationship managers or people in branches or those banks that have corporate clients.
The customer-facing folks.
Well, give them a little bit more insight than they might have been able to come up with on their own. So that's taking advantage of some superhuman analysis of data, but not really, changing the equation too much. Then when we move at a little bit higher level, we can start to create some pre-structured products which are targeted dynamically by some simple algorithms. Again, this can be a decision aid to someone who might be a relationship manager. We're getting closer to a real-time environment, closer to a relatively short decision cycle, but still filtered by a person rather than a machine. Now, the next step could be taking these pre-structured products, but using machine learning to do some of the segmentation. So we're much more specific about which segments we want to target, and that usually means that we're going to have some sort of dynamic decision aid for someone on a human-to-human scale. So that might no longer be a meeting in a branch office. It might be someone sitting on the phone in a contact center, or someone on a chatbot who's proposing a particular product. And then finally, if we take pre-structured products and then dynamically offering them to the customer, so based on the context of how they might be interacting at the moment, then we're starting to move into bank digital channels. And that might be favoring a chatbot, but starting to say goodbye a little bit to the traditional form of interaction with the client. Then finally, here's some examples. We've just used Chase as an example of their card selector product, where they have pre-structured products, but they're doing some loose amount of segmentation to start to bring consumers to a choice of their credit cards. And also servicecompare.com, which compares insurance offerings, again, trying to use some basic product characteristics, but not necessarily changing the product dynamically. So this is all products ready to go, and they're going to provide the best match based on the characteristics that the customer has mentioned. And that can go further now, and we start to say, moving into a world where perhaps the customer is no longer interacting directly with the bank, but rather a customer agent or an aggregation portal that might be doing the bidding on the customer's behalf. So we can have pre-structured products, but now these are going to be accessed via API. And we're getting into the machine-to-machine world, where the bank is an API. Of course, in Europe, that's being forced by the PSD2 regulation, which is requiring banks to open up both their parent payment capabilities and their account information capabilities. So that's really already predicting that a lot of clients are going to start to interact in an automated way. So Mint is a good example in the US of this. Mint is a personal finance portal that accesses a lot of account information on your behalf and presents it in a way that banks until now typically haven't done. Then we can move even further and say, do we want to create products in real time, which are structured through cognitive computing techniques? So getting into a higher level of sophistication, again, delivered by an API rather than a web portal, or rather than by an agent. And perhaps we're getting more sophistication on the customer side. So the customer is programming its own AI capability. So we're really now really getting the machines speaking to the machines, hopefully for the benefit of the customer.
It's like we're seeing a whole new dynamic in the front office, right? And
absolutely.
And and is the front office naturally, it was going to be perhaps one of the first, and again, the front office largely affecting the growth engine of the companies. I mean, are they going to be really the largest beneficiary? And then how do you see the benefits, downstream the organization? What are those other areas that are going to, likely to see benefits too, as this starts to evolve more?
Well, I think we still haven't shown exactly where the benefits are being passed on to the bank. And a good example here is Moven, which is a service that's been partnering with a number of banks. I think the lead partnership in the US was TD Bank, but still this is a separately branded service rather than fully integrated into into the core bank brand. So they're doing a lot of interesting things, but they're still keeping their distance. So that may be a good moment to say, where are we going to start to deliver some value?
Yeah, and so clearly there'll be some benefits within the operational areas, within the technology areas, that, as this gets more embraced, will be seen and a bit more, I would say, commonly accepted.
Yeah, well,
Yeah.
we'll take a look at some examples of where some of the operational or revenue generation areas that we can look at. Just to finish off on probably the most leading edge areas of applying artificial intelligence, we could start to see some amount of weak AI used in a trading scenario. So that might be trading on a client behalf, or perhaps creating a set of portfolio that again, someone who's just looking at this with visualizations wouldn't be able to come up with. So Betterment is an example of one of these disruptive investment houses that's starting to deploy Robo Advisory to create an optimal portfolio. And then what we haven't really seen yet a lot in the consumer space would be using strong AI to actually trade really without any further customer interaction. It's, again, bot to bot. This is important really to say, what is the level of analytics and what does that mean in terms of customer decision time? So descriptive analytics, the very basic form, lets us assume that we're going to be still in a human interaction and maybe some digital customer interaction. So the customer decision time could be anywhere from 1 to 30 minutes, let's say. And that leaves also the bank a lot of time to react, because banks can use business intelligence and reporting and use that to influence product strategy, and maybe they determine that over a weeks to months sort of period. Now we're upping the game a little bit. When we get into diagnostic, more often than not, we're talking about exclusively a digital front end, a digital user experience, and that might be a 1 to 2 minute decision time on the part of the customer. The bank's reaction time is still days to weeks, because maybe they're integrating data ingest with analytics and still using that to influence product strategy, but it's still the pre-structured products we talked about before. When we get into predictive, we're starting to run out of time, because we have to do a lot more in the 1 to 2 minutes that a customer is interacting with a website or with a mobile app. So we have not only the actual data around the products themselves, but we also have metrics of the actual user experience. So we're looking at user experience metrics. We're also getting ingest from customer data, and then we have analytics and machine learning all into the mix. A lot more things that need to interact quickly. And sure enough, product decisions from the bank itself gets down into hours, because as we get live data coming in, as we're looking at take up, we need to very quickly be able to restructure our data. The most challenging area is when we're starting to use prescriptive. And you mentioned e-commerce. This is an area where we're probably going to see the innovation coming from e-commerce, where consumers will already be exposed to how prescriptive can work in their interactions. And when it's brought this into financial services, we can get ingest running probably on an offline basis, but all of the other steps, that is product determination, evaluating that and using analytics and AI, and finally interacting with the client, is all a bot-to-bot transaction. So that's 500 milliseconds or less. A radical change into how this technology really has to work. And it's also shows the way for banks how they need to be guiding their investments. And probably the most advanced example out in the market right now is Clink, which is really bringing a lot of these much higher level statistics into the mix.
Sure, and I think that just previous to that Clink slide, that last slide there showing the evolution, right? And it's probably safe to say that from what we experience, but also what we sometimes experience in with new entities, right? That a big part, especially with existing or traditional banks, so much of it still seems to be stuck in that descriptive to moving to diagnostic area, right? Where you experience those minutes, right, of customer decision time, and and then reaction time that can extend days to weeks, right, depending on what products people are applying for. But now, like I said, where decisions are being served up and need to be made in a matter of seconds or fractions of seconds, it just shows how quickly that the traditional banking clients really need to get a plan together and start executing so they can keep pace with both the demand and what the competitive landscape is changing.
The technology is certainly out there right now on the web and in mobile apps, because e-commerce companies and advertisers are already making some dynamic decisions. Now, that's not with the same rigor that you would require for financial services, and certainly the regulation is nowhere near what you have for financial products. But at least some of the skills, some of the muscle training is already going on in that space.
And while we didn't, and I don't think we're going to spend a ton of time on, you mentioned the regulatory aspect, it almost seems like what is happening in the regulatory landscape is actually going to help accelerate a lot of this, right? Especially when you look at some of the data privacy issues that we're seeing, being born out of Europe, and while those regs may not have quite hit here yet, right? U.S. banks are going to have to, somehow align and comply with them, certainly in those regions. And different forms look to be heading our way as well too.
Correct.
So let's, why don't we move into, I think, so we can keep pace here. I think we're going to the next section now, which really is kind of how do we pull all this together, right? And how do we really reap the value from all the analytics efforts and investments that firms are making today? And where's all this heading, and where do we go, right? So maybe a good place to start for us is to, if you look at what are some of the business motivations that are driving the banks, to think hard about analytics, right? And just how much of their business or existence is really at risk via either lost growth or attrition, right? And maybe we can start there, and then naturally want to touch base on sort of what's behind that too, right? The ecosystems that are necessary to support it, right? And how that's evolving as well.
Well, let's look at some of the traditional areas that a bank really looks at for improvement. So banks want to increase their revenues, they want to grow their customer base. They want to cement loyalty and increase the net recommender, net preference scores. They want to be able to lower attrition to keep costs in check, want to be able to reduce overall costs and reduce and improve efficiency, and ultimately to mitigate risk around those areas. So, that's an opportunity for us to start looking at a number of areas around the value chain of the bank or the financial institution. So if we look at customer acquisition, that really can go after increasing revenues or growing the customer base. If we look at segmentation and cross-selling, again, increasing revenues, but also potentially opportunities to improve efficiency. All of the onboarding processes, know your customer, KYC, and credit risk, that can help us grow our customer base more efficiently, improving efficiency as before, and lowering risk. As we go into the onboarding process itself, it can keep our customer growth rates high, also cementing the loyalty in the process of onboarding. If that's a good experience, that's something that people will tell others about, and also reducing the cost of the onboarding itself. For the overall customer life cycle, we still have an opportunity to increase revenues by selling more products, by increasing fees that are earned by the institution, and again, a good payback for cementing loyalty. Still opportunities for reducing costs and lowering risk. When we look at the human user interface, again, further opportunities to have people trumpet the good experiences they've had, and also lowering attrition, which is typically a very expensive cost for most financial institutions. When we look at the machine-to-machine interface, the APIs, we still have a chance to increase revenues if we have products ready to go that are spotted and targeted based on customer needs. That can still lower attrition, because if you've got a good functioning interface, that's something that becomes very sticky and obviously reduces the overall cost of the operations. And then finally, the back-end systems and the core systems can be deployed in a number of ways, growing our customer base, keeping our efficient operations, and mitigating risk. So on this basis, we're really looking at what are some of the opportunities to start putting things together. So we start, traditional products have been master data management, so bringing diverse databases together to create a single golden source of client data that can feed into analytics processes. We also have big data that's been around for years and years and years, a lot of archival data. How far back is always an interesting question that you would want to go, but we can assume that there could be some paper data or document understanding that would need to take place to be able to take advantage of legacy big data sets. And then we're also seeing a lot more third-party data coming in. Credit databases have been around for a while. We're starting to see some insights coming into the KYC and anti-money laundering processes, macroeconomics databases, market feeds, and some non-traditional third-party sources. So social media, sentiment analysis, how customers are behaving online generally, and a lot of unstructured data sets moving into even live data. So from your mobile device, what's your location? What's the context? Are you in a decision-making mood? Are you in a transactional mood? Are you in the network right now? Are you able to talk about confidential information if you need to speak to someone at the moment, or is that not the right thing to be asking of you right now? Can we use biometrics to more usefully authenticate you, and then even taking advantage of Internet of Things devices that might be in your home or vehicle or office that can again provide insight as to how we start to have good service. What's interesting is that the analytics capabilities in a lot of these institutions are starting off from different angles of the business. So in the front office, marketing units are developing their sophistication in using analytics. Sometimes we have traditional quantitative research units within the banks that are building up further capabilities. Sometimes it's an IT group that has been tasked with building the data lake itself and uses that as a starting point for bringing on people with general analytics capabilities. Sometimes in the most sophisticated cases, we're seeing data scientists who become members of the product team itself, or can be hired on a third-party basis for dealing with very specialist needs. Equally, we could have data scientists embedded within an IT development team to further develop the platform. So providing input into which modules need to be brought together to have a basic capability. But with a lot of this going on, we could potentially have parallel efforts in the banks, and so that's obviously something that they're trying to avoid, and really gets us into the discussion of looking at the business case as well. So what we've done is we've taken a look at 3 representative mid-market banks in the U.S., up to $8 billion in revenue for one of them, and looking at kind of some of the key areas of income and revenue. So if we go after the big ones, net interest income, the income generated basically by selling products and generating deposits. Then we have the fee income, which is the areas of holding money and being able to provide different products around managing your money, both for corporates and consumers in that case. And then finally,
key source of revenue as well.
That's for sure. And then obviously going after people costs. So these are all for the 3 banks we looked at, and for basically all banks, these are kind of key areas that you can start to go after. And so that gives us a chance to start to say, what are some of the analytics areas that we're going to deploy to try to attack and target some of the improvements here. So very often we'll see analytics goals around these same overall business goals: increasing revenues, growing the customer base, cementing loyalty, increasing the NPS, lowering attrition, reducing costs, and mitigating risk. So basically, depending on which areas you select, we've got a whole group of the revenue side that can go after net interest income, reducing loss provisions, increasing service charges on deposits, and increasing garden processing revenue. So if you've got analytics capabilities in those areas, these are really the areas to go after. On the other hand, if you want to lower attrition, that's going to be most impactful on your net interest income. If you want to reduce cost and improve efficiency, then obviously IT expenses, equipment expenses generally, and how employees are being deployed are a good area to go for. And then mitigating risk, of course, will go after your loss provision. So what we've been looked at is for these typical mid-sized banks is to say, if we want to target some of these projects, such as lowering attrition, we can look at what's the addressable annual revenue that you can go after in making that happen. And so, the biggest one is really lowering attrition, and that's common in traditional banking as well. But there are a number of things that you can do in analytics to make that happen, and so we've listed some of them here. Equally, if you want to look at increasing revenues of digitally active customers, you can start to set some targets there and go after, as we can see, high double-digit millions of benefits. So growing customer base is another way, and then when it goes down through the list, looking at cards and cementing loyalty and so on.
Yeah, no, it seems to be there's considerable opportunity there, whether you're looking from a reducing attrition or managing the cost side, right? And the lowering attrition helping to play a role in in the net new growth.
Yeah, well, I think it's also an opportunity because depending on where your analytics capabilities may lie, you may be able to or not able to tackle particular areas. So what we've done is plotted some of these potential projects, improvement projects, against the general level of analytics that we feel is necessary to be able to tackle that. So as you can see, there are some high opportunity areas, and not surprisingly, the biggest ones do require higher levels of analytics and perhaps even neural networks and cognitive computing. However, increasing revenue seems to be an area that you can tackle now with the existing technologies that have been deployed, and it really kind of goes through the general sense of where you can make it happen. That's typically what we do when we work with clients, is to identify, based on your current capabilities, which projects do you really want to go after to get the maximum amount of benefit.
Right. Now this is, I think, laying it out like this, where we can see all the approaches, that can be leveraged to seize different opportunities, is helpful and compelling. I think we're going to shortly move into Q&A. A couple points too, because I think a lot of us hear about this, and perhaps a lot of our clients are concerned and hear about it too. Is we seem to be seeing a lot, or hearing a lot about different and new ecosystems, right? And some of the new versus some of the non-traditional players, and some of the traditional lines appear to be getting grayer, right? And in terms of who plays in what fields, and banks, as you touched on earlier, are being forced to open up APIs, some of the effects of new ISVs, and fintech firms as well too, who are coming to market, which with much more specialized and bundled offerings. So, how is this going to affect things, and what do banks need to do to sort of embrace the new ecosystem landscape and partner model, right? Seems to be a lot different today, and is going to continue to head more in that direction than what maybe they were traditionally accustomed to.
It's clearly a big challenge for banks, and interesting that in the European side with PSD2 that they've been forced to consider how this data is going to be used. We don't have a regulatory initiative of a similar scale in the U.S. quite yet. But we do have a lot of consumer expectations. And so, notwithstanding all of the recent revelations about how much social media data has been shared with third parties, the reality is that there are still a lot of users who have become accustomed, either explicitly or implicitly, with how their data is being used to target advertising or to offer e-commerce offerings to them. And so, to a degree, that mentality and that use of data and that to some degree level of comfort with the data is going to be brought to the bank. So the consumer is going to say, how is it that Amazon knows a lot about me? How is it that a big advertiser or Facebook or Google will know a lot about me? And actually, I see that helps me in a lot of cases. And why the bank has all my data over the past 30 years of a relationship. How is it that they can't help me? They can't even figure out what I'm doing now in my life.
Yeah, why can't they serve me better? They've got so much more stuff. No, it's interesting, and what we also see too is, right, perhaps from familiar sources to us that are using our data and serving us up things that appear to be interesting to us. we may react well, but then there's times where we get, because there's sharing of that data to sometimes other parties, right? Things that get served up to us from parties that we're not familiar with, and kind of make people feel like, well, how are these people, getting all this? So, it's like I said, but as there's, the regs are being rolled out in Europe, and again, we don't have regs today. It's in the light of recent events here in the U.S. with data breaches and perhaps the misuse of data, we could see something, perhaps something similar here for firms in here too.
Advertisers know full well when I'm looking at buying a refrigerator, and will not leave me alone for weeks and weeks and weeks when that happens. And yet most banks still can't sense when I have life events that would be much more
very opportune for them, right?
That would cement loyalty. When my kid is going to college, when I'm adding another member of the family, when I'm going into retirement.
Just managing birthdays could help them do that.
Absolutely,
right?
absolutely. So these are the sorts of things where it's kind of low-hanging fruit, subject, of course, to doing things that will satisfy regulators and ultimately satisfy customers who are very sensitive about financial data. I'm thinking of the credit reporting breaches more than Facebook in that example.
Yeah. Okay, great. All right, listen, I think we're probably right at the conclusion of the content that we want to deliver. Thank you for that, Ted. I think it's been very helpful and very informative. So again, continue to queue up some questions. We have some questions queued up, and we'd be happy to cover them for you. I do have one here too. I'll start off with this one. Ted, thanks for the informative presentation. The question is, where do you believe is the best place for banks to start, right? Are there any quick or easy wins, or as referred to, low-hanging fruit that you see that might help build a business case for continued investment, right?
Well, usually a first good step, and I'm referring to a lot of banks that we see in the U.S., someone has probably created a capability already. So if you want to move very quickly, scan around the organization and find out where a capability has been built up and what sort of data sets are they starting off with. If you use the map that we've already set out, that might be a good way to say, all right, what level of technology and sophistication have we reached already? And if so, what are some of the projects that you can start going after? And then you can really go through the level of complexity and the level of payback on a project to kind of get started with what you have right now. That's probably a safer approach than saying, well, I want to go after some of these huge projects and I'll let a large vendor sell me an expensive platform and let me go through that. I think you really do need to have a quick win, agile mentality in doing that and starting to go after particular customer segments or a particular area of efficiency or cost reduction to start to kind of get the organization equipped with this. Okay,
all right, that's great. As you pointed out, it seems to be, or I think as we went through this, right, the takeaway might be that this could be an easier feat to accomplish perhaps for a newer or more agile firm, a challenger bank, or financial firm, right? So how do you suggest that some of the more established banks go about it, right, with so many traditional stakeholders, right, and the organizational complexity that they have, right? You have corporate CDOs, you have perhaps divisional CDOs in some areas, you have corporate marketing groups who are used to owning or having a lot of control over the company's data, data stewards, different data management orgs that we talked about, right? And now you have the new introduction of data scientists and analytics teams in these organizations, which is quite a contrast, right, to what the environment. So how do you how do you go about this, right? How do you coalesce all these different groups and put together a team who can really drive progress, right? And then, like I said, these are all these various might sound obvious as data owners or managers, but then you have also the front office folks who are the beneficiaries and also, right, need to have a lot of input as to how how to move along, and they're going to want to be pulling the rest of the organization a lot faster, perhaps, than it can move.
Well, certainly banks that have reached a minimum size in the U.S. probably have multiple analytics or data science initiatives going on right now. And in fact, if depending on which end of the business you're speaking about, my data, to use that in quotes, could be interpreted a little bit differently. So my data in an IT area or an operational area is a lot different from my data in a digital portals area, or is a lot different from my data in a products area. So, I mean, you can take a number of different techniques. One is you can try to assess which of the business units has the most developed analytics, then determine which are the business areas that you can go after. So is this analytics lending itself more to customer acquisition or increasing fee revenues for existing customers, or is it better for lowering costs in a KYC context? And that can give you kind of a scaling of the types of projects that you can go after. So if it's increasing labor efficiency, that has a range of values associated with that. If it's decreasing attrition, you can look at what you can do to take analytics and decrease your attrition. So that can give you kind of a high level number, and using what we were saying before, a size of the prize, to say, yes, this initiative is something that should be a 10 to 20 million savings. This other initiative should be a 20 to 30 million increase in fees. And that starts to get you the right scaling and the right level of deployment that you have with different platforms, and helps you with some of the decisions. So one of the things that we've seen a lot is that someone has decided that analytics is good for the bank, invested millions, if not tens of millions, in getting a capability running, but there isn't really a solid business case to support it just beyond kind of some of the first successes.
Yeah. So I think it gets back to the first point or first question we have is that really needs to be the starting point, it seems.
Yeah.
Right? We have another question too, and I think this one touches a bit more on maybe perhaps maybe the architectures, maybe a little bit more of the technology side. We didn't go deeply into that because, like I said, right, a lot of it is around the business case. But this is a fact of the environments that existing banks work with, right? And I guess the question here being is, what do we do with legacy players or partners? How can we best leverage them or move away? And what benefits, if any, do they provide? Or are they one of the reasons that are holding firms back? So I think this touches on a bit some of the I would imagine evolving IT architectures, and also is about cloud and open systems models that
Certainly.
Firms are moving towards, and new ones simply start out with.
It's interesting, and most U.S. banks have still stuck with their traditional core banking systems. And in fact, as you go into smaller size banks, there are a lot of companies, such as FIS and Fiserv, and now Oracle as well, that are hosting a good part of the banking core. And so banks are somewhat constrained from their structured data by the technologies that they already have in place. That's obviously an opportunity for those vendors to sell analytics services based on that. When we did a recent comparison of mid-size U.S. banks, what we're seeing is it's become quite common to use clustered computing technologies such as Hadoop to create a data lake, which basically synchronizes with a lot of the traditional data sets and creates a new data set suitable for the sorts of data analytics that are done by data analysts. Now, the real challenge, remembering the 500 millisecond interaction that's going to come upon us soon enough, is evolving that technology to be ready to do superhuman tasks. So not just preparing data for beautiful Tableau or R visualizations, but in fact moving into machine learning or cognitive computing to make a product decision or a targeting decision, that's done within milliseconds.
Yeah, that's great. Okay, I think we have one or two more questions, but it looks like they're somewhat similar. There's some interest in, I guess, again, around the business case, which it seems like there's a lot of interest around the business, how to build the right business case, and also how to evolve and to organize organizational interests and various stakeholder groups. So, I mean, with that, we're just about at top of the hour here. So I think we could conclude the webinar. Just real quickly, I mean, first, I mean, we'd love to thank everyone for joining today, investing your time, and hopefully this has been very helpful for you. We will be posting this for replay. So if there's points you'd like to refer back to, you can certainly do that. And I think also there's contact information within the invitations. You could always follow up with Jan Claire, our marketing manager, as well too. If you'd like any individual conversations with us, we'd be happy to do that. So again, with that, I think that concludes our presentation. Thanks again for all of you for attending, and we look forward to speaking to you again on one of our upcoming webinars as we continue to develop the series.
Well, thanks for joining us all. Thanks for listening to me for the past hour, and I look forward to deepening some of these subjects, because it's a fast-moving space, and I encourage you all to kind of catch up on your reading here, because times are changing, and they're changing fast.
Yeah, thank you, Ted. I think this has been very helpful and enlightening to all of us. So appreciate all your insights here, and looking forward to our next session.
Thanks.
Thank you, everyone.